I'm Charlotte McLeod with investingnews.com, and here today with me is Mackie Piepenburg, partner at Von Greyers. Thank you so much for being here. Great to have you back once again.
It's great to be back, Charlotte. I'm looking forward to it.
Yeah, really looking forward to catching up. Our last conversation was a year ago at the same show, so much has happened.
Yeah.
And you were bullish on gold at that time, as well as the markets, as the Fed was due to start easing, which we saw. So now that the Fed has actually started cutting, what's your outlook for markets in 2025?
Yeah, I mean, I had to kind of hold my nose last year and be risk on, despite kind of having fundamental problems with this market bubble. But the Fed was clearly signaling a dovish 2025. And my simplistic reduction of how markets work is when a central bank is dovish, markets tend to rise. And when a central bank is hawkish, they tend to retract. And last year at this time, it was fairly obvious from November all the way into December and January when we met here that Powell was throwing in the towel on rate hikes and going into cuts, which is precisely what happened in 2025. It wasn't in 2024. It wasn't until later in the year, but it was already signaling. And the market, again, being Pavlovian, just the carrot dangling of a rate cut got markets galvanic and hopeful, and it was a tailwind, and we saw a pretty decent year in the S&P as expected. But again, rate cuts to me were a sign that despite not hitting target inflation and not beating the inflation, taming it, that rate cuts were a desperate move at the same time. So it was kind of bipolar, but it certainly was a tailwind for the markets. But rate cuts were also a tailwind for gold. And so obviously gold hit nominal highs in many currencies, including the US dollar. It's over 27%. In the Eurozone where I am, it's over 33%. In the Swiss franc, 36%. So obviously a very good year for gold. Again, that wasn't just market genius. I wasn't alone in that. I certainly was bullish for both, which is ironic because usually I'm very cynical, and I still am cynical about markets, and we could talk about this year. But, again, with gold, and we'll get into more detail, for gold it's always simple because debt never changes, and there's a debt collapse driven by sovereign debt crisis, not just in the U.S. but globally. And gold doesn't rise because it's in a bull market. It rises because fiat money's in a bear market. And that, just simply isn't going to change. It hasn't changed, certainly hasn't changed yet. And so 2024 was, again, not totally easy to see, but fairly accurate. And to your question now, on 2025, on the markets, I'm less bullish. Again, not just the Pavlovian, see what the Fed does. Already, Powell, it is fascinating, by the way, that we have to spend so much time talking about a central bank to discuss markets, because technically, ideally, we should have natural supply and demand, free market discovery, fundamentals, balance sheets, price to book, price to earning, a basic Benjamin Graham Buffett analysis of markets. But what we're really talking about first is the central bank. And again, as in this year, Powell is still dovish, but moderately dovish. He's talking about rate cuts, but throwing out the possibility of less rate cuts or even a potential rate hike. Just that kind of moderate language as opposed to strongly dovish language. That is already a signal that the markets are a little curious or concerned. Again, it's not the only factor. The other thing that's really amazing after this year with the S&P, and again, the contrast of the market with the real economy is appalling, and we can talk about those recession indicators, but regardless of the Main Street economy, which is just a working poor disaster, in a lot of ways stressed by years of higher for longer, but regardless of the economy being poor, there are certain basic indicators that are gravity defiant for only so long. Again, they're simple, stupid, but the Buffett indicator, market cap to GDP, S&P to GDP, that's a classic indicator, and it's at all-time highs. And not just the indicator itself at 204 or 208, those come in rare moments, and usually those peaks are followed by significant sell-offs. So the potential for gravity and mean reversion reasserting itself in the markets is more real this year than it was a year ago. The fact even that Buffett himself is so heavily into cash is a leading indicator of risk off too. That's different from last year. There's another indicator that I used to use, certainly when I was trading risk assets, is the S&P to currency in issue. And that's another ratio. You can find the charts. It's also nearing all-time highs. These are kind of large-scale, obvious, simple, stupid, I'd say, indicators that this market is really, really overvalued. The other thing about this market that's changed dramatically and gotten worse since last year is the narrowness of the market. In the 70s, I wasn't trading, but when I grew up, we had the Nifty 50, and that was considered kind of unique. Then we had the Magnificent Seven or the Fabulous Five, or now the Triumphant Trio. It just keeps getting more and more narrow. NVIDIA, again, not saying it's a bad company, overvalued company. Like I saw in the dot-com bubble, I saw companies like Lucid and Microsoft and Qualcomm, all good companies, Cisco, good companies, just grossly overvalued. And they took significant hits once the net income margins went down. NVIDIA is the classic example this year of an overvalued but strong company. But the fact that its market cap, it rose so quickly. And, NVIDIA's market cap is equivalent to 12% of U.S. GDP. So even the fact that this rising, ripping market is so narrow, or that the NASDAQ has a PE of 49. Now, the bulls would say, yeah, these narrow, very overvalued stocks, they have higher PEs, but the rest of the S&P 494 have PEs of 16 or less, or more fair valuation. But the problem is when a market is this narrowly led, when the big boys sink, and they all do, they don't die, they just sink. They don't necessarily drown, they just get reevaluated. When that happens, all ships go down in a lower tide. They take them with them. So the narrowness, the broader indicators, these things are very interesting. And again, it's not just a gold bug trying to be negative. I'm going to be relatively agnostic on the markets. They will affect the gold price. But it's, Druckenmüller, Jeremy Grantham, Paul Tudor Jones, Gundlach in the bond market. Most of the portfolio managers that I know in the city or in New York or in London are going more and more to cash, because it's just starting to feel that this is getting to the point, again, can't be timed just on instinct, but it's starting to look frothy. And so all these combinations matter. And then the classics, Benjamin Graham valuation still matters. Charlie McKay on the madness of the crowd is just starting to feel a little more maddening than even it did last year. Last year was so obvious because Powell was giving you a green light. And, I think even the mostly forgotten Robert Farrell, that all markets mean revert, unless, of course, the Fed decides to nationalize essentially the markets and produce liquidity. They probably will, but it won't be until there's an uh-oh moment, and then the fire hoses and the bazooka and the QE comes out. For a long time, the Fed has been focusing on rates to manage. They only have two tools, right? Rate cuts and balance sheet. So every problem, when all you have is a hammer, everything looks like a nail. For now, they've been working with rates. Powell's kind of flip-flopping a little bit on that, or textually not being completely clear, which is typical of Powell. But the only other option they have if things really hit the fan is, QE. And I think at some point we'll see QE to the moon, but that's very hard to predict. But for those stock pickers out there, what I would look at when you look at the markets, one thing I've learned from good portfolio managers, I'll say it again, look at the leading stocks driving the S&P and the NASDAQ. Look at their net income margins. They're rising now. When they start to go flat, that's fine. When they actually start to go negative and consistently negative, that's when you can call close to a top. And even when they fall, it won't be in a straight line. But right now, there's still liquidity through the TGA, through the reverse repo. That's drying up. TGA has got about $650 billion. But there's always the opportunity to mouse click money out of thin air if Powell's compliant and supportive, or if he lets markets have natural price discovery. It'll be very interesting. But no matter what, long answer to short question, not nearly as bullish as I was last year on the markets.
Yeah. I think it's nice to have the long answer and then the succinct way of summing it up. So we covered a lot of ground there, and including, I was going to definitely ask you about Fed activities in 2025, which I think you did a good job going over there. I was reading a piece that you wrote kind of on your outlook for 2025, and you kind of explained there what people really need to pay attention to right now is the bond market. And you point out that the Fed's real mandate is making sure that the bond market doesn't die. So what would that look like in 2025? What's the state of the bond market right now?
Yeah, I keep saying in a lot of articles, and I'll maybe for years, kind of a play on Shakespeare, the bond market is the thing. The bond market is the thing. And really, what is the bond market? It's about credit. Credit's about debt. And when you understand that, and it doesn't take a lot of thought, once you understand the fundamentals of it, it really helps you understand all other asset classes and sectors and areas and topics, because debt is the key stone for the ripple effect on everything we could talk about, whether it's currencies, whether it's the bond market, whether it's Fed policy, whether it's the precious metals market, whether it's currency risk. It all comes from this debt collapse. It's not sensational anymore. This debt collapse is driven by sovereign debt that's gone too far. Clearly in the U.S. at $36.2 trillion and racing, that's a sovereign debt problem. The U.S. is the home of the world reserve currency and the 10-year treasury. So the U.S. sovereign debt problem is a critical problem, but you obviously have the same problem in Europe. You have the same problem in Canada. You have the same problem in many countries. Ironically, not in Russia as much as in China or other countries. Russia has much less debt, ironically. But when you understand that, okay, there's a sovereign debt crisis, that they're over their skis in debt, and that debt isn't sustainable, and again, 36 trillion is appalling. It doesn't even include the 200 trillion unfunded liabilities. So it's clearly an unsustainable debt level. And if productivity, GDP, or tax receipts aren't there, well, then you have a problem. You have a delta, you have a gap. And typically, central banks fill that gap either directly through QE or taking from the Treasury General Account or exploiting the reverse repo markets or other mechanisms of indirect QE. But that is running dry in the reverse repo, and the TGA only has so much, as I said. And the other thing is you can issue more debt and float it. The problem is, for a number of reasons, less and less buyers for those treasury auctions exist for two key reasons. One, again, whether you agree with the BRICS narrative or not, there is a de-dollarization process. It's not overnight. It's not going to destroy the dollar. It's not going to replace the dollar. But that process is taking demand away from the dollar, and there's less demand for U.S. treasuries. So foreigners are buying less of them. China and Japan in particular are key, traditionally our two number one buyers of U.S. treasuries, are net sellers this year. So the weaponization, and not just the weaponization that's made other nations, particularly the BRICS nations, less interested in our IOU, our U.S. 10-year, the fact that our country's in so much debt makes us a less appealing IOU in terms of real or inflation-adjusted returns for foreign investors too. So these factors all mean there's less demand for that bond market. So when there's less demand, bond prices go down. And people need to understand this isn't rocket science. When bond prices go down, yields go up. And rising yields are like shark fins to the economy, because rising yields are the real interest rate. It's not the Fed funds rate. It's not what the Fed or Powell tells you. It's what the bond market tells you. And when the yield on the 10-year of these bonds start rising, those are like shark fins. And they scare away a lot of things. They hurt the S&P because the S&P is driven by companies that borrow, and rising yields are the price of debt, the cost of borrowing. So when they go higher, that slows things down. Bond prices go down. When bond prices are under threat, when yields are rising, stocks tend to go down. Obviously, the rising cost of debt hurts households and businesses and individuals. It hurts mortgage. It hurts real estate. So, I mean, I think mortgage applications are down 63% this year in the U.S. That's back to 1995 levels. So, again, they're all connected from this topic of debt, the purchasing of that debt, lack of demand for that debt, rising yields are the sharks that are chewing on the hope of all these different sectors. That's not sensational. That's actually happening now. And that'll be a big challenge for any Fed official or any incoming president to try and control those yields. And if they can't control them through GDP, taxes, treasury auctions, foreign demand, all of which are not as strong as they were years ago, they're going to have to create liquidity or synthetic liquidity, and that is currency debasing. And of course, that ties to gold too. So again, when you talk about debt, you're really hitting every major area, sector, or talking point, and it makes it fairly easy to track once you understand how terrifying rising yields are to just about everything in the economy except the U.S. dollar, because rising yields help the dollar. And then the only real strong thing is the dollar. Everything else goes down. But what's interesting about gold we can talk about is despite a rising DXY or a rising dollar, gold is just decoupled. It's still rising. So that's an interesting thing as well.
Yeah, definitely we want to make it over to gold. I think I've got one more point to bring up before we go there. And it's, you mentioned we've got a new incoming president in the U.S. So I do want to get your thoughts. I know this is a big topic on how he plays into this, and it's a little tricky to talk about right now because literally Inauguration Day is tomorrow. But what can you say about that? Because when we were in the lead up to the election, I kept hearing, well, nobody's talking about the debt. Well, it doesn't make a difference who's going to be president. We do have Trump coming in with his efficiency ideas. So what are we looking at there?
I mean, it's a really important topic. It's extremely hard to synthesize in 3 to 4 minutes, but it's a very relevant. Obviously, as you said, tomorrow there's many things you can say about Trump. He typically does what he says. Whether what he does is successful is a very different thing. Again, it's not meant to be denigrating him. He has certainly more energy in Trump than there was in the last administration. Whether that energy is for good, for bad, sublime, ridiculous, that's to be determined. There's some sense that at least there's action. Trump has a few key themes, the tariffs, this Department of Government efficiency, which we can talk about, which again, I'll just say the short answer is those are inflationary policies. And he said he was going to beat inflation. I think he may not said that disingenuously. I think he underestimates that. I don't know if that's condescending, but I think he does. And he has this desire to beat inflation. He has this desire to cut spending. He has this desire for tariffs and this government efficiency. And before you can even look at all of those things, which I think are going to be inflationary, at the top of the pyramid of that discussion is the key to him succeeding is to get debt to GDP down. And the problem is with debt, and whether it's him or I've said Santa Claus or Papa Smurf, that's going to be hard for anyone. So I don't blame him in and of itself. It's going to be very hard unless he cuts severely into entitlements and military spending, because entitlements, military spending, and interest on debt are 75% of the budget. There's not a lot of room to play. So if he really wants to take the debt part of the debt to GDP ratio down, he's going to have to make a revolutionary change in entitlements or military. That's very politically difficult to do. The Department of Government Efficiency and the pink slipping of 75% of the fat and bureaucracy of D.C. is wonderfully optics. It's very good. There's a lot of waste in D.C. bureaucracy, just like there's in any bureaucracy. But 25% of GDP comes from government. So if you just pink slip the Department of Education and a lot of waste on the Beltway in D.C., that has great optics politically. It may even be necessary. But you don't want to do that with a strong dollar, because you're going to be letting a lot of people out. There's going to be a decline in GDP just by the nature of government spending. And even with Elon Musk and Vivek doing that, again, these are complex topics. They take more than a few minutes. But the question is, does he even have the mandate for that? He has the mandate to raise tariffs through executive order. D.C. is very embedded, very full of political, I hate to say the word prostitutes. They'll do whatever their lobbyists tell them. They'll do what their embedded structure is. So they will sacrifice whatever values for the country they have for the good of their lobbyists. And the question is, with the majority in the Senate, the House, et cetera, can Trump really get Vivek and Musk to have full reign to do the kind of things and get the support from the legislator? We'll see. But again, to do the cutting of the fat in D.C., I understand that will have an effect on GDP, though. And that necessarily, when you lay off levy people, when you have a strong dollar, you put them into a levered economy. 70% of GDP comes from the consumer. If you've got less consumer strength, that actually makes GDP worse. So he's battling a lot of moving parts. I'm not saying he'll fail, but it is certainly going to be important to do that with a weaker dollar. And that's another topic. But the other big topic, of course, is tariffs. And there's two ways to look at the tariffs. On the positive side, clearly, for example, I live in France. The French have a 25% tariff on American wines. I live in Bordeaux. You can't find American wine in a French restaurant. It's a simple example. So you can say heroically, Trump is saying we've got to make changes. There's imbalances in trade. We got to play hardball, and this is how we're going to do it. That's the positive side. The extremes, 45% tariff to Canada, 100% to BRICS, to trade outside that. These are very dangerous things. They're very inflationary things. And I think despite all the good intentions to reorganize fair trade, which I understand, and again, this could be 30 minutes on this, but I'll try and simplify one small example of how this, history doesn't repeat itself, but it rhymes. We did try tariffs in 1930 under Hoover. It was called the Smoot-Hawley Tariff Act. Blow the dust off the history. Again, it's not exactly the same situation, but it's close. And the long and short of it was, when they did those tariffs, it was a disaster. First of all, Hoover didn't get reelected. Both Smoot and Hawley, the senators that it was named after, didn't get their seats back. It led to a massive amount of retaliation and export declines from us, the tariff the wall maker. So there's going to be reaction, tit for tat. And the question is, who can hold their breath the longest on this? How much instability will it create? How much inflation will it create? How much stress will it put on our economy? What the pro-Trump camp would say is, yeah, those are possible risks, but the only way to reshore manufacturing is, frankly, to punish American CIOs and companies offshore in Asia, in South America, getting cheaper labor, putting a huge, pain on their products coming in. So if they really want to have an American buyer, an American camp, an American demand, they better bring their manufacturing back to avoid those tariffs. And I can understand the optics of that. So again, there's a lot of if but going on. Trump will definitely do what he says. Again, whether that's efficient, whether everyone cooperates, whether the West of the world cooperates, whether GDP cooperates. But the bottom line is, unless he gets the debt to GDP ratio down, he can't succeed, because historically when debt to GDP crosses the Rubicon of 100%, we're at 125. I mean, this is going back to classic economics, certainly to David Hume. Growth stalls by 1/3. And you need to get growth, you need to get productivity in the GDP. Deregulation that Trump is going to offer, that's helpful. But again, that will not be enough. He's going to have to really cut the debt side. And the spending cuts that the Doge camp will create isn't nearly enough. Frankly, fire a lot of people in D.C., it's a lot of jobs. You can save $25 billion in interest expenses by cutting interest rates by 25 bips. So it'd be actually easier if the Fed cooperates with Trump. And that's a whole other issue too. Will the Fed be accommodative to Trump? If he is, what he wants, he's king of debt, as he says, he's going to need rates cut and money printed to inflate his way out of this debt crisis. We'll see.
We will see, and appreciate you taking this massive topic and trying to break it down in this very short time and at a key turning point right now. So hopefully, maybe we give Trump a few months in office and bring you back and try to work out in a longer conversation. But for now, so we want to get back to gold, and I'll finish on the note of gold because that's always important to our audience, and I think this gives great context. Yeah. So for you, I know you see gold, this is a tool for wealth preservation, and I think many of our audience will see it that way as well. But what is your outlook for gold under these circumstances in 2025? Yeah,
it was a broken record, but it's sad. Gold it's easy for me because the rest of the world just keeps continuing to make the same mistakes and governments continue to make the same desperate mistakes. Hopefully there'll be a change at some point, a tipping point. But as long as the world and governments continue to run deficits like they do, and right now we're the fiscal quarter or the fiscal calendar for America starts in October. And so we have October and November numbers. We're already $690 billion in deficit and this is the fiscal year that Trump's inheriting. I mean, that is insanity. That's where we were at COVID. So we're spending a deficit spending as if we were in World War II at the same inflation-adjusted, currency-adjusted numbers, but we're not at war. The reason we're running deficits is we simply don't have the GDP and the tax receipts, so we're going to monetize that with liquidity, fake liquidity, which is inherently inflationary. So your question about gold, this is just an example of the debt disaster that our budget is in. Regardless of Elon, regardless of Vivek, regardless of campaign rhetoric, those are facts. You can have your own opinions, but those are facts. And those facts tell me that we're going to need to synthetically support this broken debt market. Again, everything starts with the bond market. It all comes back to debt. And unfortunately, the policies to do that are going to be currency debasing policies. So again, gold doesn't rise, fiat gets weaker. It's certainly true even in the home of the world reserve currency. That's going to be true in all major currencies. And so since 1971, all the major currencies have lost 99% when measured against gold. So for me, it's not that gold rises, fiat money gets weaker. It's not sexy, it preserves money. I look at dollars, Canadian, American, South African, Australian, they're just ice cubes, beautiful ice cubes that are slowly melting. Whereas gold, boring, not so sexy, holds its value, and actually can go up in price appreciation optionality in this kind of market like we've seen this year. It's outperformed the S&P, which was at a blowout year, and it's still outperformed. But again, are you not entertained? Gold's not doing enough. It's a very misunderstood asset. But we who understand gold for preservation purposes are certainly happy to see the speculation benefit or the price appreciation benefit, but we're not speculators. And it sounds very smug, and I know for a lot of people that are worried about getting through the month, this doesn't help them because they're trying to get growth and they're trying to get return. The vast majority of my clients or our clients are in the stay rich camp, not the get rich. You can take your risk elsewhere. You can take it in crypto, you can take it in Nvidia, you can take it in tech, you can ride the roller coaster of volatility and stomach churning vol. Or go long some tech thesis. But it's for gold and our clients in 90 countries, I never get a phone call asking about the price because we just know, not smugly, gold just sits there and holds its value while fiat money is very busy losing its purchasing power. So we're very, very strong on the preservation camp. Speculating in gold is very difficult. In the futures, the options, you have to be pretty good at that. And you can, but we're not. And because we're not speculators, we're almost too confident. Gold, of course, doesn't go in a straight line. Of course not. But we do know it outperforms fiat money in the long term without exception, just because central banks are our best friends. They're trapped. They're stupid. There's no way out of this. As Paul Tudor Jones said, all roads lead to inflation. Eventually, I would change my tune if we cut debt to GDP down significantly, if a new administration came in and played real hardball with the military and with entitlements. Yeah, and honestly, that would be what is necessary now. It's just, and Trump doesn't need to get reelected. He can really do things now for the country without having to worry about reelection. Whatever he does, he has to do it fast. He's got 2 years till the midterm. He's got a majority in the House. This is the time. And he's going to come out, whatever you think of him, and again, sublimely ridiculous, he's going to come out running with the boxing gloves on. And he'll probably break a few plates in the china shop when he does that. But we're starting tomorrow and this coming week, we're going to see some pretty drastic changes.
Yeah, undoubtedly. I think that's maybe the one thing you can say with certainty heading into this year.
Yeah.
Okay, so we got through a lot, still a lot that we couldn't put on the table this time, but yeah. I think we'll wrap it up here. And again, I do hope maybe we can have a longer discussion in the future, but great to have you here today.
Thank you.
Thank you very much.
It's my pleasure. Thank you.
Of course. And once again, I'm Charlotte McLeod with investingyouth.com, and this is Matthew Piepenburg. Thank you for watching. If you like this video, make sure you hit the like button and subscribe to our channel. We'd also love to hear your thoughts, so leave us a comment below.